Welcome to the SWIB Podcast, where members of the Wisconsin retirement system can turn for timely information on the investments that help fund the state's pension system. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB.
And I'm Dusty Weiss, producer of the podcast.
Investments in the private markets is one aspect of SWIB's diversified investment portfolio, but there are many ways to invest in the private markets. One approach that has been gathering momentum in the past decade is co-investment. In a private market context, co-investing involves buying equity or debt in private companies alongside a private equity or private credit fund. What are the benefits of these investments and how do they help the core trust fund? How has SWIB built and grown its co-investment portfolio? And what is the outlook for co-investments going forward? Today, we're going to get answers to those questions as we discuss private equity co-investments and learn more about how SWIB was an early adopter in building out an internal co-investment program with Chris Eckerman and Kirk Wolff of SWIB's private equity and co-investment team.
The SWIB Podcast is a regular opportunity for you to learn more about the people and trust funds that comprise the Wisconsin retirement system and SWIB, the state agency responsible for managing the retirement system's more than $155 billion in assets for over 677,000 participants. Please make sure you're subscribed in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members and leave us a review on Apple Podcasts so it's easier for other members to find this show.
Joining us are Chris Eckerman and Kirk Wolff. Chris is Senior Portfolio Manager, Head of Co-Investments on SWIB's Private Equity and Co-Investments team. He's been with SWIB for almost 11 years. Prior to joining SWIB, Chris worked for a $100 million growth equity and venture capital fund, which he and two partners spun out of a family office in Texas. He started his career as an investment banking analyst. Chris also held operating roles, including one with a private equity-backed company. Chris earned both his bachelor's degree in finance and his master's of business administration degree from the University of Texas's McCombs School of Business. Kirk Wolff is a portfolio manager on SWIB's private equity and co-investments team. He's been at SWIB since 2018. Prior to his tenure at SWIB, Kirk held the position of vice president at Muller & Monroe Asset Management in Chicago. His journey in finance began as an investment associate at Altius Associates. Educationally, Kirk holds a bachelor's degree in economics from the University of Wisconsin-Madison and further honed his skills by obtaining a master's degree from the University of Virginia McIntire School of Commerce. His commitment to professional excellence is underscored by his status as a chartered financial analyst charter holder. Chris and Kirk, welcome to the SWIB Podcast.
Thanks for having us. Glad to be here.
Gentlemen, it's great to make your acquaintance here, and I wanted to start with you, Chris. You've got a lot of experience in the financial industry, as Chris Preisler just told us there, but what people might not know about you is that you are an accomplished swimmer. During your time at the University of Texas, you were co-captain of the men's swim team and a member of Texas's 1996 NCAA championship team. And in fact, you earned an American record as part of the relay team. You've mentioned that swimming has been and continues to be an important part of your life. Can you tell us a little bit more about that?
Sure. Swimming plays an important part in my physical and mental well-being. I swim 3 to 4 mornings per week when my schedule permits. I also recently became an assistant coach for a master swimming team here in Madison. I've been fortunate to develop lifelong connections through the sport, which has provided several interesting experiences, including participating on teams that have completed the Lanai to Maui Channel swim in Hawaii several times. Plus, my wife tells me I'm less grouchy when I swim. I actually think it's fairly common to find former athletes in private market investment management because of the tools you develop during those experiences.
Open water ocean swimming is certainly something that's not for the faint of heart. I've had a little bit of not personal experience with that, but been up close and personal with people who have. How far is the Lanai to Maui Channel swim?
It's just under 10 miles as the crow flies, but because of the current, it's more like 11 to 12 miles, depending upon the strength of the current on any given day.
How long does that take you?
Again, it really depends on the current, but it could take you anywhere from about 3 hours to 5 hours. It's a relay team. So you're 30 minutes in the water swimming, you're 2.5 hours on the boat. It's a 6-person team. And then you're 10 minutes in the water, 50 minutes on the boat. So it's a pretty nice gig. You're sitting on a boat in the middle of paradise for a couple of hours, just checking out the scenery while somebody else has to do the work.
Well, I still don't think I'll be signing up anytime soon, to be perfectly frank with you.
Yeah, I won't either, for sure. Chris, you have an interesting story about how you landed at SWIB. Can you tell us about that?
Sure. One of our colleagues, John Drake, had been chatting with someone at another public pension plan about co-investing. John ended up spearheading a research project, which resulted in the private equity team recommending that SWIB start an in-house co-invest program. That led to a SWIB initiative, and ultimately I joined the organization in the fall of 2013 to launch the program.
Kirk, you've also got an impressive background. Can you tell us a little bit more about how you got into the financial industry and how you landed at SWIB?
Yeah, I've kind of always been curious about how companies work. It also helps I find math and numbers maybe a little bit more enjoyable than most. And so that kind of pulled me towards the finance industry. And as I was going through grad school and trying to triangulate where was the fit with my interests and potential job opportunities, I came across private equity and learned about how private equity buys companies and shapes them, and thought it was an interesting career path to pursue, and landed my first job at Altius Associates on the limited partner side of things, which is where SWIB sits when it comes to private equity investing. And it really was kind of a trial by fire, which afforded me the opportunity to learn a lot early on in my career.
When you say you were thrown into the fire and kind of had to learn on the fly, what do you mean by that?
Yeah, both of my previous firms I worked at were small investment shops where, there were only a few junior people. And it just so happened when I arrived at my first opportunity, a few senior people left. So a lot of the responsibilities that usually fell upon more senior individuals fell onto us junior individuals. So we were kind of told to take on a lot that would have been given to senior folks. So as I said, I was able to learn a lot in a short period of time, which I think definitely benefited me in my career and has helped me here at SWIB as well. But maybe going back to landing at SWIB, I've been spending the majority of my time on the private equity funds investing landscape and had done some co-investments to date, but having a good grasp and understanding of the fund side of things, really wanted to lean into the co-investments. And it just so happened SWIB had an opportunity open, and I think I had found it through the CFA website. And I had always heard really good things about SWIB in the market as an investor, and the team having some consistency and just doing maybe more unique things than other public pension plans. A lot of the clients I had at my former jobs were public pension plans as well. So SWIB had always stood out. And so when the opportunity arose, I jumped on it and feel lucky to land at a place that, one, there's good people to work with and are doing interesting things. So happy to have spent the last 5 years here.
So as we get today's discussion started, let's start with a little bit of investing 101. Our listeners are going to hear some terms like PE, which is private equity, or LP, which is limited partner. But we're talking about co-investments. So for those listeners who might not know, what are co-investments?
Generically, a co-investment is a direct investment into a company alongside one of our external managers. It's most often in the context of a minority investment in a leveraged buyout transaction. I like to use the analogy of buying a house. An individual puts up 20% of the home price and borrows the other 80% from a mortgage lender. The lender looks to the individual's income for repayment. In the meantime, the lender holds the home as collateral. A leveraged buyout is pretty much the same thing, except for instead of an individual, it's an investor group. Instead of a home, it's a company. The biggest differences are the dollar amounts involved, the amount of equity contributed, and the funding sources. Compared to other public pension plans, SWIB was an early adopter in building out an internal co-invest program. Co-investments provide greater transparency, control, and the potential for higher returns relative to primary fund investments.
So you mentioned, Chris, that SWIB was an early adopter in building out an internal co-investment program. Why did SWIB decide that was something worth doing, and have other public pensions followed SWIB's example?
Good question. In a primary fund commitment, the manager typically receives an ongoing fee for investing the capital called a management fee. They also receive a split of the profits. We don't typically pay those fees on a co-investment, so there is the potential to improve net returns through lower cost. Again, SWIB's reputation, policies, and compensation structure allow us to recruit and retain people with the right skill sets to effectively transact in the co-invest market. One of those key elements is delegated authority. SWIB's board of trustees and its investment committee have empowered staff to make investment decisions. Speed and certainty to close are important differentiators in the co-invest market. SWIB's delegated authority model is a big contributor to our ability to distinguish ourselves. Interest in co-investing has risen significantly over the past 10 years. There are several models, but we talked briefly about why the in-house model was the right approach for SWIB. We started with an idea and now have committed approximately $3 billion across more than 125 co-investments while delivering strong risk-adjusted returns. The co-invest program has contributed to the private equity team delivering nearly $2 billion of net economic value add over the past 10 years.
You know, one of the great joys of co-hosting this podcast is getting to learn the many ways that SWIB has a diverse portfolio of tools that's essentially serving the interests of the Wisconsin retirement system and its members. So what would you say is the goal of this portfolio, and how does it fit into SWIB's overall investment strategy for the core trust fund?
To quote Warren Buffett, rule number 1 is never lose money, and rule number 2 is never forget rule number 1. The simplicity of the advice is what makes it funny, at least to us finance nerds, because everyone knows it's harder to do than it is to say. However, I quote it because our goal is to deliver strong returns to the CTF and therefore our pensioners. We strive to deliver that performance goal by achieving other goals along the way. We view co-investments as a mutually beneficial arrangement whereby our private equity managers get to use our capital to complete a transaction. And as Chris mentioned, we get to participate on a fee-free, carry-free opportunity, and that hopefully increases our net performance at the end of the day. And we build a portfolio of these co-investments to provide diversification. And so the second order goals of co-investment is to better understand our PE partners, and that is to help us better underwrite the funds we're committing to through the overall private equity program. And we also view it as a way to build upon the relationship. So hopefully they show us more co-investment opportunities in the future. We feel it as kind of like a virtuous circle. We commit to private equity funds that therefore show us co-investment. And if we do a good job as partners with the co-investment, it begets more co-investments. And as I say, better understanding of the private equity managers themselves. So hopefully we find better managers. And as I said, I think that's a very fortunate, virtuous circle for us at SWIB. And to answer the second part of your question of how it fits into the overall investment strategy for the CTF, as I mentioned, we try to build a diversified portfolio of co-investments. We do that to spread out risk. SWIB takes the same approach at the CTF level. The SWIB leaders allocate capital to different asset classes, of which private equity is one. And then within private equity, we allocate about 75-80% of the capital to funds, and then the remaining 20-25% to co-investments. SWIB has been thoughtful about aligning the goals of the organization. So if we achieve our goals in the co-investment program, it accrues to the overall goals of SWIB and the CTF.
If I could just add one thing to what Kirk said, co-investment provides a unique insight into a manager and its processes. We think co-investing makes us better fund investors. If you want to know what a group is like, do a deal with them. You'll quickly understand if reality matches the marketing hype.
You mentioned a little bit, Kirk, about the virtuous cycle of working with fund managers and that opening up new opportunities to get involved with as well. And certainly a substantial part of the lift of the private equity team's work involves hunting for those fund managers and finding the best ones. And I mean, collectively, those managers are investing in hundreds of companies each year. I know that not every deal may involve co-investment and that you're not just buying into every deal that comes across your desk. How do you wind up deciding which opportunities to invest in?
We look at a multitude of factors when deciding to invest. We are effectively underwriting both the manager and the attributes of the deal itself. We typically have a running start on the manager evaluation because we mostly co-invest alongside our existing relationships. We look at the manager's track record in the sector. We also look at the performance of their co-investments. Does the deal match the manager's strategy and core area of excellence? Have they been successful with this type of value creation plan in prior deals? Ideally, we're investing alongside the best performing partner from the top firm specializing in that sector. We also look at the key underwriting criteria of the company. For example, does the company have a strong management team? Does the sector have long-term secular tailwinds or headwinds? Is there an M&A consolidation story? How appropriate is the valuation? What is the capital structure, including leverage? Ultimately, we're focused on the opportunities with the strongest risk-adjusted return expectations. In other words, we're looking for opportunities that have multiple ways to be successful under various economic backdrops.
So how many co-investment deals does SWIB typically make in a year or on average?
Yeah, the target, as I mentioned, we shoot for is 20 to 25% of our PE annual commitments, which is kind of penciled out to about $500 or $600 million a year. We have a couple portfolios within private equity, one being our normal private equity portfolio, and then one that we call a current return portfolio, which has more debt-like opportunities in it. And we have different size allocations for co-investment based on which portfolio the opportunity is coming from. For private equity, we typically have a range of $30 to $50 million per opportunity. And then on the current return side, we like to have a sweet spot of about $25 to $40 million. But we also have flexibility to go smaller or larger than that, depending on the opportunity. We feel like this is an advantage for SWIB. It allows you to be a better partner for your private equity manager. Depending on the size of the opportunity, having the flexibility to go smaller or lower may engender you to the private equity manager, either on this opportunity or going forward, knowing that you have flexibility. Maybe they show you different opportunities that maybe other people are more prescriptive about their sizes, won't participate in. And then we also have more lower middle market managers than I would say a public pension plan of our size. And given that they're smaller managers, they try to typically write smaller checks into the companies they're investing in. So if we were to say only have a lower size of 30, that might be bigger than the check that the private equity manager themselves are writing in. And since we want to be good partners to both our large private equity managers and our small ones, the flexibility to participate in both small and large deals, it allows us to be partners to both our large and small managers, which in turn hopefully provides more co-investment opportunity in the future as those private equity firms grow themselves. I guess that's a long-winded way of answering your questions, but it's to say that there's a number of small checks we write and then some larger ones too. So over the last few years, we've roughly done 20 to 30 co-investments per year across those size ranges. That may seem like a big or small number to different people, but we review 4 to 5, maybe even more times that amount of opportunities to get us down to that 20 plus that we actually end up doing. We think being selective in this manner has helped us achieve our returns to date.
We've touched on some of the advantages of private equity co-investment, including the greater transparency, control, and potentially higher returns. But what are some of the challenges that you have to navigate with this sort of investment, and how does SWIB handle those challenges?
One risk is the potential for adverse selection. This refers to a concept where a manager will seek to maximize exposure to their best deals and reduce exposure to less attractive deals, possibly through offering co-invest. As mentioned previously, we look at the performance of the manager's co-investments compared to their overall performance. Additionally, we focus strongly on alignment with the manager to alleviate concerns. Another potential challenge are quick timelines. We try to provide quick feedback in a couple of days, and we often only have weeks to decide whether to participate. Fortunately, our team has the resources to meet these timelines. Additionally, we talked about SWIB's delegated authority. Our streamlined investment process is conducive to operating under these time requirements. Also, the co-investment team works with a cross-functional team from across the SWIB organization. I'll call out 2 areas where SWIB is able to effectively address other challenges of the co-investment market. The first is on the legal side. Often we're required to sign confidentiality agreements and non-reliance letters to access diligence information on opportunities. We need to turn these documents around quickly in the context of deal timelines. Fortunately, we have talented individuals on SWIB's legal team with corporate securities backgrounds that enable us to meet this challenge. Second, I'd like to acknowledge our operations team. The reporting and valuation considerations for co-investments and other direct deals are different from fund investments. Fortunately, SWIB has a strong operations team that's able to handle these situations.
We've certainly talked a lot on this podcast about market volatility throughout the different asset classes. Last year, private equity activity remained sharply down from its pandemic peak, due in large part to that sticky high inflation, elevated interest rates, capital costs. How has this impacted co-investment opportunities? Can you talk a little bit about how the SWIB co-investments portfolio performed last year?
In the early days of the pandemic, we focused on existing portfolio company risk. but SWIB's long-term investment horizon also enabled us to proactively seek opportunities while the financing markets were dislocated. The window of opportunity ended up being relatively short due to unprecedented fiscal and monetary stimulus. This fueled robust economic and deal activity, which ultimately led to its own set of challenges, including inflation and elevated interest rates. Higher interest rates present a challenge for buyouts due to the use of debt. Higher borrowing costs and lower availability of debt has increased the equity requirement for deals. But while overall deal activity declined meaningfully from the peak in 2021, higher equity contribution has been a tailwind for co-investment, especially since SWIB's flexible asset allocation model and fully funded status didn't require us to pull back from the market like some public pensions, foundations, and endowments. As Kirk mentioned, we're focused on the lower middle market and middle markets. We also have a value orientation. These deals tend to use lower leverage on average and typically have multiple organic growth levers with the intent of positioning the portfolio to perform well through economic cycles. SWIB's co-investments performed strongly last year on an absolute and relative basis. More importantly, those investments were highly accretive to our overall private equity and core trust fund performance.
So looking big picture now, Kirk, what is the overall state of private equity fundraising today, and what do you see for the coming year? With the more constrained levels of debt financing, how has the co-investment deal landscape changed?
Yeah, the challenges that have been mentioned for last year are carrying over into 2024 because really not much has changed. We've still seen elevated interest rates, and I think one of the main driving factors in the challenges for PE fundraising last year and into this year has been the lack of distributions to investors. The M&A market was relatively soft compared to the prior 2 years, and without deals being sold and therefore capital returned to LPs, there was just a more limited amount that they were able to invest into new private equity funds. And so what we saw was kind of a bifurcated market, a lot of haves and have-nots, as we would call it. And that seems to be the case here early in 2024. You'll see even good managers that haven't had trouble raising funds in the past take longer to raise money. If it was, 6 to 12 months in the height of 21 and 22, 18 months isn't atypical to see these days in the market. With LPs waiting to get money back through distributions, they're just taking their time before they contribute more capital to private equity. And then you layer on top of that, some people still dealing with denominator effects or allocation issues. The fundraising market, I think, will continue to be challenging this year. SWIB is not immune to the denominator effect or all these other things, but the leaders of SWIB have been thoughtful about establishing ranges for private equity. So we are able to be proactive during times of uncertainty.
So listeners might not know, but what is a denominator effect?
Changes in private markets tend to lag public markets. So the denominator effect occurs when one portion of a portfolio decreases dramatically, thus diminishing the overall portfolio value. So any segment that did not decrease in value now comprises a much larger percentage of the total. So you can find yourself over allocated to a particular asset class.
So you could easily see, like in an instance, let's say somebody was allocated 10% of private equity on $100 million, that's 10 and 100, but that 100 shrinks to 90, all of a sudden that private equity is more than 10%. So that's what the denominator effect is. And it works in both directions. And as I mentioned, SWIB's been very thoughtful about their approach, which allows us to have a range to operate in. So that way, when there is volatility, which there always is in markets, we don't have to do anything that would impact kind of how we operate. And then jumping into co-invest and how the landscape's changed due to all these factors. Yes, debt capacity has been taken out of the market, which means equity contributions are increasing. And what that has translated into is more co-investment opportunity for us. As private equity managers look to fill out that equity portion of their capital structure, they're turning to their LP partners. In years past, they may have turned to other GPs and partnered on deals to get a transaction done, but the market has become more sophisticated for co-investment. LPs themselves are more sophisticated, and that's kind of been to our benefit. That's what having track record now of 10 years as a co-investment program over 120 deals done, as Chris mentioned. We're considered pretty good co-investment partners these days, especially with the GP relationships we have. So as the market changes, we'll try to capitalize on it as best as we can.
You said like timelines are drawn out in terms of fundraising, but one of the advantages that SWIB has, you mentioned earlier, is the fact that the WRS is fully funded. We can be a little bit more patient because we're long-term investors. Is that correct?
Yeah. If you want to participate in the private equity markets, you have to think long-term. A lot of the funds we're investing in have 10-year lives to them. The companies they invest in, they typically underwrite holding from 3 to 7 years. So having the long-term mindset approach in private equity is very prudent to have. And in today's market where funds are taking longer to raise, one thing you can do is be patient before you come into a close of a fund. In some of those cases, they may already have a couple deals in the fund. We call them seasoned primaries. Typically, if you're going to funds called blind pool risk, there's no deals done yet. You're just giving them money and telling them, here, fill it with 10 plus companies and report to us along the way. Whereas if they have a couple deals in the portfolio already, you have kind of a view into what they're going to be doing with this new fund. On the flip side, if you have the flexibility that SWIB has as well, you can be an early closer into a fund and sometimes drive terms for those funds. And sometimes that can mean more co-investment. It can mean better terms when it comes to economic arrangements. So maybe lower fees, again, trying to drive the overall net performance of SWIB to a better result.
Chris and Kirk, thanks for taking some time to talk to us about co-investments and how they fit into SWIB's investment strategy for the Wisconsin retirement system. It was a great discussion today. Thank you again for joining us on the podcast.
Thank you.
Thanks for having us.
And thank you to all our listeners for checking out this episode of the SWIB Podcast.
The SWIB Podcast is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media, branded podcast production for businesses, podcampmedia.com. Our editor for this episode was Matt Covarrubias.
Thanks again for listening. I'm Chris Preisler.
And I'm Dusty Weiss.